Thank you very much. Good afternoon, everyone. Today, I think the theme is largely clear. We heard in the earlier session during the day, people were questioning that are we actually using or making the best use of technology. It's very common for us to use AI, ML very loosely, interchangeably. Are we actually doing business analytics, or is it really an AI or ML that we're talking about? It became a good fad for everyone to just talk about AI and ML. That's a reality. I had an interesting session yesterday. We were discussing as to what impact this is going to have on actuaries as a profession. On an extreme, someone said the junior level jobs of all actuaries will go away. Give it 3 years and this is done. Someone said, I don't think the job of an actuary will go away. The thing is that people will need to be more qualified in terms of making the right judgment. Now, how do you make a right judgment when technology is making choices for you? And how do we blend with ourselves in the whole decision-making process as actuaries that we are expected to do? That was one framework, one question that probably gets stuck into my mind when I look at some of these topics that are coming our way. Second thing, most important thing is when we are doing our improvements in our day-to-day jobs, in technology, upgrades, are we always satisfied that we have done justice to the last mile? Is something there more that I can do? I can tell you my experience when I joined my job as an appointed actuary. I looked at the existing data systems. We looked at revamp, what can be done, what can be automated, and then we are very happy. My CEO gave me a target to reduce the reserving cycle from 6 days, 7 days at that point in time to about 2 to 3 days, and we achieved that. The way he did was, you have 21 days, I take it off, I need on 15th, deliver it, go back and do it. And we took a couple of quarters, and we came back and said, yes, 15 days, we are able to do it now. But the same question was posed by a board in a different manner. Why are you conducting your board meetings on 15th or 16th of the month? Why can't you do on 5th of the month? Now, what is stopping you? When companies like Infosys, TCS are able to do their board meetings within a week, what's stopping you? You're so minuscule in the size and scale. So I think it's imperative at our end that we do a self-conscious understanding that at every point in time, at a periodic interval, the technology is upgrading, technology is improving. How I can embed into my day-to-day work, how do I can learn from it, what I can achieve for it. Today, we have 2 young actuaries who are not confined the way we are thinking. They've gone out of the way and then evaluated what propositions can be made within general insurance to upgrade ourselves, to help ourselves to do things better. The idea is not to replace actuaries. The idea is to assist the actuaries in the day-to-day work. And I guess they have a couple of examples, one in the traditional area of reserving, and the other one is going to be close to pricing or other areas. So I'll invite Mohit to look at it.
Hello. Hello. Yeah, thank you. Thank you, sir, for your words. So if I just go on to the agenda of today, so we'll just discuss what are the general problems in reserving and pricing, and how AI and technology can help in reserving and pricing. And we'll also have a quick overview of portfolio analytics and how AI and tech can help in portfolio analytics and fraud detection as well. So the main problems of reserving, if I just speak about the problems of reserving, are the fact that now it is becoming very imperative, considering that IFRS is going to come into the near picture, and we are also moving into an RBC world, like the RBC capital world. So it is important to determine what the best estimate reserves are or what the best estimate ultimate is. So this is one area or one problem where basically actuaries face is what should be my best estimate reserve or what should be my best estimate ultimate. Secondly, we know that the reporting times are becoming challenging and they're becoming more faster and faster. Similarly, the teams are also changing and it is becoming dynamic. So for example, if there is person A who was doing reserving for a particular LOB, but now it is a person B who is doing reserving for that same LOB. So to determine objectively what way we should reserve is becoming difficult, and there's no objectivity with respect to this reserving structure. And the processes are also slow, and therefore the time is very limited. And additionally, what is happening is that we as reserving actuaries might miss out on different trends while we are doing reserving because the time is actually very limited to us. So if I just talk about how AI and technology can help us with respect to this, and additionally I'll just be using MI and AL on a side note, so those basically are synonyms to each other. So we have something called the machine-led reserving. So the basic objectives of the machine-led reserving are that it can help you to calculate what your best estimate reserves or ultimate are using an objective method. And I'll just discuss what the objective method is in my next few slides. But what it is trying to do is basically it will try to minimize your actual versus expected analysis, as well as there's something called the cumulative development result. So when we are trying to minimize those, it becomes an objectified manner of determining what your best estimate reserves are. Once your best estimate reserves are actually determined, so you can actually calculate what your carried reserves are, and the appointed actuary can make a judgment on the amount of reserves they want to increase or they want to decrease in a particular period of time. Apart from that, it is obviously scalable, that there are different LOBs, like the number of LOBs that you can create reserving via the machine-led reserving would be very high. And what it does is that for short-tail lines and for stable lines like motor, OD or health, so it can give you good credible results, and therefore you have a lot of ample time left where you can focus on different complex lines such as motor TP. And additionally, it is a completely transparent approach that it is completely auditable. Now, if I just show you how the machine-led reserving works, is that if you see the green part over there, that is basically your observed data. And if you see the orange part, that is your training data. So it is imperative to note that the machine-led reserving works on a calendar period basis. So if you see, what we are trying to do is that if you have an incurred triangle, which is a development triangle over here, so it divides the data into two parts, that is your actual data and your training data. Now in the training data, what it will do is that, as I already mentioned, that it will take two factors, that is the actual versus expected analysis, as well as the cumulative development results. So I'll just explain what these are now. So what it will do is basically, at every training data, it will try to calculate what your expected claims are and what your actual claims have been. And it will try to minimize the difference between what your expected claims have been and what your actual claims have been. So it will keep on running different type of simulations until the actual versus expected analysis is minimized. Additionally, there is something called the cumulative development result. So what it actually does is that for an accident period, you have your opening ultimate, and then as the time progresses, there would also be a closing ultimate. So the difference between the closing ultimate and the opening ultimate for every accident period also needs to be minimized. So what it is actually doing is that it is creating an objective function by using AVE, that is the actual versus expected analysis, as well as the cumulative development result, that is the difference between your closing ultimate and opening ultimate for every accident period. So it will try to minimize all of these to give you a particular best estimate reserve or a best estimate ultimate. So if I just, I've briefly talked about all of these. So if you just look at the AVE over here, so what it is trying to do is that the green part, the dark green part is the actual, and the orange part is the expected, and it will try to minimize the expected and actual across different calendar periods. So you can, in the machine-led reserving also, what you can do is that you can bifurcate how many number of calendar periods you need to estimate. That is how many calendar periods you need your expected incurred to be. So if you increase that, there definitely the complexity and the time period would increase. But generally, 3 years to 4 years of expected data calculation with respect to expected and actual gives us credible results with respect to this. Now, similarly, I've just explained the cumulative development result. So finally, what we are trying to do is that you can create a weighted average of AV and CDR to minimize the difference between the actual versus expected and the cumulative development result, such that you have an objective way of defining what your best estimate reserves are. So what it actually does is that there are a number of simulations that you can run through the machine-led reserving. So like you can tell different inputs to the machine-led reserving and it will create all those simulations, and then it will create all these simulations, and then it will create a deterministic set of results where the AV and the CDR is basically minimized. So the simulations basically can be on the number of volumes of DFMs. So you can select volume 2, 3, 4. You can give a lot of inputs to the machine, and it will run all these simulations, and it will try to create a particular function where the AV and the CDR is basically minimized. Similarly, there might be different simulations on methods, such as if you want to select the DFM, BF, or the ILR method, or if you want to simulate on the curve fitting, whether you want to select a V-bull or an inverse power curve, and from where do you want to select the tail curve. And additionally, at what point that the tail should be completely be close to 1. So the runoff period is also what you can do is you can determine using the number of simulations that you can create. Additionally, what we think of is that AI and tech can also help in determining your initial estimate of case estimate reserves, such that they're not volatile. It can basically run through your prior case estimates and can give you what your true case estimates for the recent period should be. And there's something which is also called optimized segmentation, where, for example, if you have number of LOBs and you are very confused on what grounds or what type of LOBs you need to do reserving upon. So what it will do is that it will, first of all, see, depending upon the homogeneity of the data, and it will compare different volumes, patterns, ATAs, LDFs, CDFs, in order to determine what are the different lines of business you should actually do your reserving upon. Ultimately, it can also help in frequency analysis, severity, and inflation analysis. And ultimately, what we are trying to say is that once your data is finally corrected and you have your optimum structure and your optimum resource with respect, because you're using AI and tech, so you will have some ample amount of time where you can even look at industry data, such as IIB data, where you can decipher number of different trends which might not be visible in your company data right now. So it is actually helpful to the different insurance companies as well. Apart from that, it might also be helpful to different consultants as well. So just two use cases over here might be, if I'm a consultant and I am seeing what my reserves are, it can just show you the comparison between what my estimate is and what the machine is giving. Similarly, it can also show the difference between what the machine is giving and what the actual company has held over. So there are different types and different structures and which we can basically use with respect to AI and technology, which can aid and help in reserving. So I'll invite Deshna now to speak on pricing.
Yeah, thank you, Mohit. So we move forward to the impact of AI and technology in the pricing processes. So the first and the foremost thing that we need to understand is what is exactly the problem with the traditional methods, right? So when we start with a pricing process, whether it's for motor, health, or any commercial line of business, so there might be a lot of fields that are present in the data that you have, right? So for example, if I'm pricing for a motor product, there might be a lot of fields in your motor data that will try to explain your claims cost or frequency or severity separately. So these explanatory variables are known as rating factors. So if, for example, you have 10s or 20s of rating factors in your data, you might want to select an optimum number of rating factors, and those rating factors which are actually helping you predict your model better. So when we start adding a lot of rating factors to our model, the model itself becomes too complex. So the problem with this is we need to strike the right balance between the number of rating factors that we use so that our model doesn't become too complex, and we also do not lose out on the predictiveness. So that is the first problem. Moving on, so the most commonly used pricing models are the GLMs, or the generalized linear models, right? So these models are inherently built on the foundation that the relationship between these rating factors and the target outcome, like frequency or severity, they are based on a linear relationship, which might not be the case in reality. Now, fitting GLMs is basically a slow and a manual process. So for example, if you have tens of rating factors, so you might start with a GLM which has all the 10 rating factors, and you start off with deleting one of the rating factors basis the impact. Or you can start off with one rating factor in the GLM at a time, and then you assess the impact of adding more rating factors. So which makes the entire pricing process more complex and complicated. So for example, if I look at the graph here, I'm modeling my data, so my training data is highlighted by the dark green line. As soon as I try adding more rating factors, I am only getting diminishing returns, right? So I am getting diminishing returns after adding more factors, but my complexity of the model is also increasing. But if I use this model and predict my actual behavior, those diminishing returns might not even exist. So you are only making your model complex and losing out on the performance. So the solution to all of this is the machine learning models. So machine learning models like decision trees, gradient boosting machines, and neural networks have more predictive accuracy, and you can also handle multiple data set types. One of the most important output of these models is the feature importance, which I'm going to cover in the next few slides. A quick recap of how decision trees and GBMs work. So on my left is a quick decision tree. So it is a flow chart-like structure wherein you are basically trying to answer a particular question. So you are splitting your groups into different subcategories, and the resultant answer is your final outcome. GBM is built on this particular algorithm, which is the decision tree algorithm. So you are not only creating one decision tree, but you are also creating decision trees on the residuals, right? So you are basically trying to minimize all the residuals that are present in your data. This would give you basically a boosted prediction. So for example, if your actual trend is depicted by the blue line, what GBM output will give you that this particular line, which is the red line, is closer to a bluer line, so that you have the minimum residuals. Now moving on to the main output that is achieved using the GBM algorithm. So for example, you are again modeling for a motor own damage cover, right? You are modeling for either frequency or severity. You have 10s or 20s of rating factors in your data. You just fed these rating factors into the machine-led model, which is GBM. Then the model will give you a list of rating factors in descending order, which are important in your model predictions. So for example, in this particular chart, I have NCD at the top, followed by vehicle age, model, and vehicle CC. So this means that in predicting my frequency or severity, NCD is the most important factor, followed by vehicle age and model. So rather than assessing the impact of adding factor by factor in your GLM model, you can just start off with this technique. You can have a list of factors that are important to the model and just plug this output into your GLMs.
Gentlemen, a very important announcement. There is a slightly technical issue. We'll just wait for 5 minutes and we'll definitely get over. Any queries as of now that we wish to have anything right now for discussion for our speakers? Sure. Can we have one more mic there?
Hi, the model that you were just talking about, how do the rating, how does that machine learning model assign the importance to the rating factors?
So basically, for example, you are talking about the gradient boosting machine, right?
Yeah.
So you are just giving the algorithm 10 or 20 factors that you have in your data. What it will run is, it will run a lot of decision trees at the background. First decision tree, it runs. The residuals from that decision tree, it takes up for as an input to the another decision tree. So first decision tree is on my entire data. The second model is based on the residuals of the first decision tree. And the third model or the third decision tree is based on the residuals of the second decision tree, right? So as soon as you start basically boosting your decision trees, you would have a minimal set of residuals at the end. So, yeah.
Yeah. I think what she's trying to say is a machine learning model doesn't need to be told what factors to use. It looks at all the variables that are there and look at the response variables and identify which rating factor is going to give the best response outcome. That's the whole purpose the algorithm works. It maximizes the response in terms of where it's coming from. So automatically the classification will come. So this is what is saying that NCD is the biggest factor when it comes to response. If you're looking at frequency, the frequency is the biggest predictor through NCD. That's what the algorithm will automatically go.
Thank you.
So this was the factor importance chart. That was an output of the GBM algorithm. Yeah. So either you can take the entire output from the GBM algorithm and just plug it into the GLM model, or there is another functionality which is the automatic GLMs or the auto GLMs. So from the GBMs and other machine learning techniques, what we get is we get a list of important factors that are important to predict your frequency or severity. You can also boost your models in such a way that you also get the interactions present between those terms. Apart from factors and interactions, you can also get the custom groupings and simplifications on those factors and interactions. Using these output from the machine learning techniques, you can just feed in all of these inputs to the machine, which are the initial factors, initial interactions, and the proposed simplifications. The machine will bulk test these assumptions and evaluate and adjust the trends. So it will run a lot of simulations and will give you an optimal level of GLM. So rather than inputting the factors from GBM to the GLMs, you can just automate your GLM process as well. So moving on to clustering. So this is another machine learning technique, which is clustering. So now you can also use geography as a rating factor. So for example, if you want to charge different prices by PIN code or by state, so you can use clustering as a machine learning technique, which would help you assess how risky is your particular PIN code is or how risky your state is. So you can charge, for example, different prices in Mumbai as compared to Chandigarh. Excuse me.
Hello. Hi, I was just curious to know, can you go on that slide where you were showing the results of, motor rating factors? I was just curious to know whether you were able to compare these results with the traditional approach, like the traditional approach which we have currently. It also tells us, right, which one is the most relevant rating factor and which is the least relevant. So were you able to compare these results with the traditional approach and gauge the difference, how different is this one with the traditional one?
So basically, to answer your question, we are currently looking at motor insurance, right? So when we look at motor insurance, a lot of rating factors that are more prevalent or relevant to that particular product comes into mind. But for example, if we are looking at some other line of business for which we don't have much idea on, So there might be some hidden factors and interactions that might be more predictive, so that this machine learning technique helps you identify those factors and interactions as well. But to answer your question, when we compare these results with the traditional GLMs, so there are a lot of times when we miss out on certain interactions, which we do not see that these might be even relevant. Yeah.
Okay. So my question was basically on the credibility of these results only. That if we, if there is a vast deviance between these results and the traditional results, then, it puts up a question on the credibility of these results.
But I think if you are trying to use machine learning technique, so currently it is just an input to your GLMs, right? The final rate tables are coming out of the GLMs. So for example, if you are comparing your results from the GLMs and using machine learning techniques, so you can use other statistical options like lift curves and gains curve. So from my experience, if I say, I have worked on one of the projects. So I have seen lift charts and gains curve comparing both of them. And there is not, basically not very different result from machine learning techniques. So you can say that if you have the correct data, you might and even get the correct results using machine learning.
Thank you very much. Thank you. This was helpful.
Yeah, your example about doing a geographical pricing where you can do a pin code or district-wise pricing is interesting, but do you have technology right now which can help you do a spatial smoothing? Because one district, next district, very different pricing means people will be encouraged to abuse that. So can you do spatial smoothing also in this?
Yes. So basically, after using clustering, you can use adjacency smoothing and spatial smoothing.
And,
Yeah.
okay.
So there are softwares present in the market that does this. So
Also, you'll have separate software for this. You don't have ML algorithms available to do
so
that.
there are some open sources that you can use for clustering and other smoothing techniques. But what I have been using is WTW's radar. So you can also do clustering and apply adjacency smoothing and spatial smoothing there.
Okay. Thank you.
Could you go to the slide where there was a comparison between the fitted, like it was a better fit, the red curve versus the blue curve? Yeah. What's the chance of overfitting in this case? I mean, yes, it's a better fit, and it's probably, but is there a possibility? Not the one after this. Yeah, this one. So what's the chance of overfitting in case of using this model?
So it is, what this graph is telling you is that, for example, my blue line is the actual trend that I'm observing, right? So what my GBM would do is, it would just try to predict whatever whatever trends you are observing in your actual data, right? So it will try to capture as much of the trends as possible, and you will basically minimize your residuals. So that's the first thing that this algorithm is doing. Now, to the question of overfitting. So when you just give the rating factors or the fields that you want to assess, so GBM already incorporates or automatically basically redacts the fields that might overfit your model. So for example, there might be a few rating factors that are just noises, right? So that, if I just go to this slide, so those factors might not even come up on this. So you might not end up using those factors.
Thank you.
If I may add, I think the best way to look at from a machine learning perspective today would be that if actuaries are doing their own base modeling, you can create several challenger models and test the hypothesis that is there a better model that can beat your best view. Right? That's a starting point for a lot of the actuaries to start working with, rather than blindly believing that machine learning algorithms or models can really help you for better pricing. So each company would have their own base model that they believe is the best model that they believe is appropriate and reflects the current market pricing. Can we use machine algorithms to create challenger models? And do we see a better uplift in any particular manner? Is that what can be starting point?
So moving on. So AI and technology in other domains. So we are going to cover portfolio analysis and claims. So within portfolio analysis, you can identify profitable segments using the same technique like that was used for geographical based location. So you can use clustering to identify your high profit end customers. Also, you can optimize your portfolio. So you can just give the machine a return percentage, for example, and you can optimize your portfolio in the sense that for this particular return percentage, what is my minimum risk? So this thing can also be done using machines. From claims analytics, you can do image and video analysis. So a lot of companies have started using image and video analysis to assess their claims, right? So the AI, you can basically bring in the AI using in this particular image and video analysis so that the claims team does not have to deep dive into each of the images and videos. The AI can basically help you assess whether a particular claim is total loss or partial loss. You can also use fraud models. So the machine learning algorithm can identify hidden patterns of fraudulent activities.